Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show, and I'm pleased to be joined by a guest that we just had on, it was about 2 weeks ago, I believe, and had a number of questions and topics outstanding at the end of the show, so Doug was gracious enough to come back on for a second episode. Doug, thanks so much for taking the time to do part two on this.
My pleasure. Great to be back. Thank you.
So, a number of great things that we discussed last time, but there's a few threads that we have to pull on the distress in the market right now, what the capital markets are actually looking like, and then investor appetite to actually deploy capital. And interestingly, I saw Starwood REIT put out or they've been in the news a lot lately for not just having a lot of people want to make withdrawals, but their capital raise has gone from 700 million, I think that was per quarter, down to 15 million a quarter. So not only are they getting a lot of withdrawals, but they're also seeing much less on the demand side to deploy capital. So maybe we could jump in there, and then I'll also open it up. If people have questions that they want to ask Doug, just put it in the chat. If it's a follow-up question, or if you want to dig a little bit deeper into it, happy to address that. But first, let's talk about the distress. What are you seeing in the market? Is there actually any distress in the industrial space, or is that more centralized right now in office and perhaps leading in a little bit to multifamily?
Yeah, well, for someone with liquidity like myself, there's not enough distress for my taste. I'd like there to be more, but maybe if I could take a step back, and I would call this period that we're going through, which started with the Fed tightening cycle, which now we're almost 2.5 years into, as kind of a great recalibration of values for commercial real estate in the U.S. and obviously elsewhere. Uh, we're lucky on the industrial side that we have a little bit of a buffer. We have great fundamentals, et cetera, but we're not immune from that. And so just to kind of illustrate the impact on valuations, if you had an assumption that you were building a project and it was going to generate $100 a year of net operating income, and that was going to give you a 5% yield on cost. So just NOI divided by your cost equals 5%. And then that cash flow that you created was going to be valued by the market at a 4% return, so a four cap. So obviously that's good news, because if you take $100 of NOI and put a 25 multiple on it, you're talking about something that's worth $2,500. So follow me on the math, right? But if that cap rate, that return that investors demand, goes from just 4% to say 6%, then the multiple on the NOI goes down to 16.7, and your asset then is only worth $1,670. And so you could see that that's a huge swing with just 200 basis points of movement in cap rates. And the Fed's moved up the fund rate by 500 basis points. And so to further take a step back, the entire commercial real estate market in the US is priced off of what investors think of as the risk-free investment, which is generally the 10-year treasury. So we're a spread off of the 10-year. So if the 10-year is, I think I saw this morning on CNBC, something like 4.46 or 4.47, then investors in our product are going to want some risk premium for that. And that risk premium can range from very little at some points in the cycle to up to 250 basis points. So right now, I'd say the risk premium for industrial is probably 100 to 150. So now I think we're at a place where industrial cap rates are, say, 5.5 or 6. I'm generalizing, but there were 4 before. So, one thing doesn't change is your cost basis. So it costs me, if it cost me $2,000 to create this NOI of 100, and now instead of being worth 2,500, my asset's only worth 1,670. That's like Scooby-Doo, rut-row. But it's not a disaster as long as you're still getting NOI. But then if you put the pressure on where you have a short-term maturity and you borrowed 60% of the cost, and now you borrowed 1,200 out of the 2,000, but the asset's only worth 1,670. Or if it's an 8 cap, the asset's only worth 1,250 and you borrowed 1,200. Now you have a forced distress sale type of event. And a lot of the debt in commercial US real estate is interest only, and it floats. And so it's subject to these ups and downs, and it's fairly short maturity. A lot of stuff is 3 and 5 year stuff, and so it's getting ready to roll. And so there's this lag in the marketplace that that the fuse was lit in early 2022. Now we're going to see in 24 and 25 and beyond that a lot of forced selling is going to come to the market. So that's the basic impact on valuations. If I invested at $2,000 and my asset's worth 2,500, that's a good day. That's a 25% margin, or 20%, 25% margin, excuse me. That's a very, very good day. But now that's inverted. And so there's this recalibration of valuations that's occurring kind of in slow motion as it moves through the ecosystem. That's what we're up against.
So with all of that in mind, generalizing, what do you think the market should be down, and what do you think the market is down from peak early 2022 pricing?
Well, I'm an expert sort of on the industrial side. When you say the market valuations, how much are they off peak in terms of percentage?
Yeah.
I would say fully 25%, maybe more. And again, then you have all the situations. What's the quality of the credit of the customer? Where's the asset? Is it in Southern California, or is it in the middle of Iowa? All those sorts of things that come into valuations that have to be thought through. But I think 25 to 30% isn't a bad place to start the conversation.
Yeah, and I think that's very surprising for a lot of people to hear, because industrial is still doing really well. That interest rate risk isn't being factored into a lot of people's, at least sellers, decision making, because everybody in real estate wants to make money in real estate. I found it's not the same mentality as stocks, where if you buy a stock at $100 a share and it goes down to 80, well, you just know that that's a real market. There's always this delusion that the market will always recover, or it should still be worth $100 a square foot because that's what it was worth 2 years ago. And it causes a lot of people to be very stubborn. But it's funny you mentioned that number, because that's exactly what I thought as well. Is if you look just at how interest rates have risen, that has to put upward pressure on cap rates. That's what I say as well, is 20 to 25%. The market has to be down in aggregate that amount just because of that interest rate fluctuation. But that's still very hard for a seller to wrap their heads around, especially if they're fully rented. They've got 100%.
So then you say, well, why would you be a seller?
Mm-hmm.
Why would you sell into this market? Why wouldn't you just hold? And the answer is lots of things, and many of those things are situational. The needs of your capital partner. I talked about the forces that debt can impart at the asset level. And I don't want to speak about Starwood specifically, but we could talk about those redemption queues and closed-end funds and non-traded REITs. People want their money back. Well, what's liquid right now? Is office liquid? Retail? Multi? I would argue that of the major 4 food groups, industrial has the most liquidity. So that's why we're seeing deals come into the marketplace and selling into what we all would say is not a great seller's market, because they need liquidity, and this is where they can find it.
Yeah, especially if they're upside down in their office portion, like you said, there might not be any equity or in there if they were forced sale. Whereas even industrial, if you're down 20, 25%, but you've owned that for 5 or 10 years, there's probably still a chunk of equity. So yeah, I think that's a great way of describing it. So what are you seeing in the deals that you're looking at in these forced sales? Do the sellers just acknowledge that they have to be realistic with the market, and if that means selling for 20, 25% less, that's just what it is? Or do you still see there being that wide delta between bid ask?
I think sellers are going through the stages of grief and they haven't really gotten to acceptance yet. So in 22 and 23, there was this idea that we were going to see some loosening by the Fed, certainly by this time, or maybe even by the middle of last year. It never happened. I would argue, and I'm sure you're all watching and reading the same things I am, it's probably not going to happen in 24, right? It's going to get pushed out again. So you go from thinking we're going to wait it out, and now we're starting to see some seller capitulation in the marketplace because they've marked these assets to market. So they've already taken the loss on book, and now they're just ready to get on with life. And so that's creeping into the marketplace. So I think the bid-ask spread is narrowing as we move further into the cycle. And it's mostly because sellers have come to the realization that if they really do want to be a seller, this is where they have to trade.
Yeah, that's very interesting on that. When are you hearing any owners that are coming up against their debt coverage ratios? So if they have a lease or a loan coming up for maturity and interest rates, maybe they're coming off at 3.5 and now they're looking at 6.5, and that affects just their ability to cover their DSCR. Are you seeing any force sales from the bank, or is the bank just saying, we don't want to take this back right now either, but perhaps you have to do a cash in refinance if that money's available? Have you heard of any of these situations?
Again, I think we're very early in the cycle for industrial, but for the other sectors, certainly office. Well, that's where the world is for them right now. So, but on the industrial side, there's still equity generally, even if values are off, like we talked about. NOI has still generally been strong. Rents have grown. So the numerator is still strong. That's important for everybody to know. If we start to see erosion of the numerator, then this whole thing is going to go in a different direction. But
Which is kind of what office has seen.
Exactly. And then, of course, they have the great misfortune of having a very highly capital intensive uh, asset class as well, which exacerbates everything.
Mm-hmm. So with all that in context, what are you seeing in the capital markets right now and appetite to lend into this environment? I can't imagine it's easy trying to buy anything in the office sector. Multifamily's probably got challenges as well, but industrial specifically, is there still appetite to lend on the right product to the right group?
Well, let's talk about both sides of the capital stack. So I just got back from 3 days in Toronto, meeting with institutional investors. Obviously, we're pitching our own book, but we're also having conversations about the market as a whole. I find their posture to be cautiously pessimistic. So they spend a good part because they span asset classes, they span continents. Their worldview is much broader than mine. I'm the guy that comes in and says, "Yeah, but we're different. We're U.S. logistics, we're different." But you're across from the table are people that have spent the morning working on the asset classes you're talking about, Chad. And I'm a little bit of a breath of fresh air, but I'm swimming up against a tide. The tide is going against me. So they've got their own challenges on mathematics. We've all talked and heard about the denominator effect. If you're running $100 billion fund and the value of the fund over a short period of time, because of the value of the debt component, drops by 10%. Now it's a $90 billion fund. Your mandate for commercial real estate is 10%. So you had 10 billion invested in commercial real estate. Well, now 10 billion over 90, you're out of compliance with your mandate. You're $1 billion long in commercial real estate. So have someone like me come in and say, "Yeah, I'd like you to invest another 150 million in our fund." Well, where's it coming from? Their pressures are in the other direction. They're trying to figure out how am I getting, how am I handling my denominator impact when I'm a billion long on commercial real estate? What am I going to do about that? And that gets back to what's liquid. What's liquid? U.S. logistics real estate. So, this is these problems start to interrelate and magnify each other. So that's, going into the meetings that I was in this week, that's what I'm sitting across from the table from. Everyone gets the industrial story. You don't even have to talk about the tailwinds. You don't have to talk about e-commerce. You don't talk. They get that. It's all about what is the universe of the possible for them at this point in time. And I sat in a meeting yesterday with an existing Canadian investor, very sophisticated people. They'd invested 150 in our prior fund, and we're coming up to the close of our most recent fund. And they said, look, we may be good for 75. We love you guys. Love what you've done. Love everything about the strategy. Love your performance. We may have 75. And so that's the climate on the equity side. On the debt side, we still don't have a functioning CMBS market for the kind of mega deals that we saw in the prior cycle. So if you want to borrow $1 billion to buy a $2 billion industrial portfolio, that you have to knit together, a consortium of lenders. It's too big for the life cos. But the life cos are back, kind of in their sweet spot. Construction debt is very difficult to find above 25 or 30 million. And that's only if you're in the circle of friendship. So one of our money bank lenders said he had 25 clients he was lending to, borrowers, sponsors. Now he has 4. They've shrunk the circle of friendship from 25 to 4. But this is all part of the natural order when you think about it, because what does that do? That constrains new supply. What does that do? If demand is constant, it'll raise the value of existing assets and the NOIs will go up. And then, the market will heal itself. And that's why I'm calling this a recalibration, because everyone just needs to, find their place in the new world order. But it's during these times of transition where a lot of people get hurt.
So what do you think people that are perhaps in that position and may not even know it yet? So perhaps it's, like you said, the stages of grief, you got to come to acceptance first. Maybe they need to get to that acceptance stage. But assuming that they're close, or at least in there, what does someone do to shore up their balance sheet, ensure that numerator stays in a position where you're at least solvent? What do you recommend that companies do right now?
I'm not sure what can be done after the fact. It's before the fact that matters. It's investing where you're going to have a sustainable differentiating advantage. Remember we talked about that last time? And that's the moat that you build around your NOI. If you haven't done that and you're just floating along with the currents, I'm not sure what can be done, actually. All that I could say is, and I've said to my team, when there's an opportunity to lease space and there's a physical fit with this tenant, we need to make that deal. We need about 1,000, because the next tenant coming along could be 6 or 12 months from now. So you don't want to chase the market down. We haven't seen downward pressure on rents, but we also haven't seen the full impact of the Fed's actions on the American consumer. And I think that's going to be the story of 2025.
Yeah, can you expand on that? Because I'm personally very fascinated on how it hasn't affected the consumer yet. Just very simple math. And maybe everyone's on a 30-year fixed mortgage and this nullifies it to some extent. But I have to think that if the next generation of people coming in to get a mortgage, or if someone did do a 5 or a 10-year mortgage and they were at 2.5% and now they're looking at 6.5%, that average mortgage that's got to add $750 to $1,000 a month in extra costs. Then you've got property taxes going up, insurance going up, cost of living going up. What's your interpretation on why there hasn't been more of an impact on the average consumer?
I think I can point to 2 things. One has to do with a lot of people locked in. What is it? Half the country is a homeowner. Is that the right number, Chad, or in that range?
Yeah, I've heard somewhere around there too.
Yeah. I think a lot of those people did the right thing and locked in at the right time, those that could. So they have a little insulation. But let's not forget that about $6 trillion fell out of a helicopter and got sprinkled around the country over the course of just a couple of short years, right? I mean, That's how much liquidity was put into the system. And I'm not saying that was a wrong thing to do from a fiscal policy perspective, although I have my own opinions about that. But I think now that's being burned through. That cushion's being burned through. And so if you look at credit card delinquencies and auto loans and some of the canaries in the coal mine, the consumer confidence index, and a lot of that, it's a flashing yellow light right now that suggests that for a lot of the country, it's a struggle. And I think that's really going to come home in 25.
So what does this look like with all that in mind in your view for the next year? We're almost midway through 2024.
Yeah.
Election, I think, is going to dominate the headlines for the better part of the fall. What do you see this looking like? And I mean, you can take this any direction you want, because even the construction side that you said, very hard to get construction
Hmm.
loans right now. And even those that can get a construction loan, if you're borrowing at 400 basis points higher than you were 2 years ago, that probably doesn't look very appealing. So you're going to have construction tailing off, new product getting added, but not a whole lot of new construction coming in. And then you're also faced with these loans maturing, uh, asset classes of everything potentially seeing some pitfalls. How do you, and I'm asking you to, in an impossible question where you've got to have a very clear crystal ball, but where do you see this looking in a year or two from now?
Well, my head's exploding with those cross currents you just described. um, yeah, I think it's my job as the leader of the firm to be thinking about where the puck is going. So I think about it a lot. On the fundamentals, there will be an uptick in vacancy rates in the U.S. That's already trending for industrial. I think it'll stay well within the range of what we consider to be healthy market conditions. So we're coming off of very tight conditions to more of a balanced market. That means probably national occupancies of 93 and a half, 94 and a half kind of number off of 97 and a half. I mean, it was massively tight for a while. And then there's going to be a supply cliff, which is already occurring. So it takes about a year to build these buildings. And we're still working through a good deal of what was committed and then started in 22 and 23 that's coming on the market. We'll probably reach peak vacancy in the second half of this year. And then as the supply cliff kicks in, 25 and 26 look like we'll go right back to those tight conditions that will favor landlords. And even in the so-called softer market that we're in, we're still seeing positive rent growth in almost every market in the country.
Hmm.
So this is not the great financial crisis where we saw, uh, you know, occupancies fall below 90% nationally and rent growth go negative for a whole bunch of quarters in a row. So it's not that. Uh, but there is going to be, I think, a more competitive market for the next 12 months. But from where I sit as a landlord, I think pricing power is coming back latter half of next year into 26. And if these tight lending and capital market conditions persist, then my expectation is supply will continue at a much lower level than demand, even beyond 25 and 26. So it'll take about 2 years from the point at which players start to come back in en masse, right? For the supply to get back to where it was. So even if they started today and everyone decided, okay, there's a new market cycle here, let's all go out and buy land and start to finance and construct. That's it. It's 2 years until those get delivered from conception to actual delivery and lease up. So I think
You
there's an interesting period coming where we go from a looser conditions to tighter market conditions quite rapidly.
which industrial really hasn't experienced outside of the Great Recession, where there was pretty sizable shock. But there's a lot of, and I went through that. I started in '05. So I went through the Great Recession, so I still have the battle scars for that. There's a lot of people that have gone through a 15-year bull market where they haven't had a downturn to even go through. So
Yeah.
this is going to cause some scars for sure.
and my kids are about this age, but for those that came in to the business when they were in their mid-20s and now they're 40 and have never seen a correction like this. Everything's been up and to the right their entire career. So it's up to the old guys like me to help guide us all through what we think is coming. I'm not foreseeing anything like the great financial crisis, although I wouldn't put the probability at zero, but I'm not thinking that that's what's going to happen.
Is there anything that scares you into thinking that that could be a possibility?
Yes, uh, the amount of debt that the U.S. Treasury is trying to sell into the market. At what point does the appetite for U.S. debt become satiated at these interest rates? Um, and what interest rates do the buyers of U.S. debt demand of us? And if we have a failed auction, things could turn, or an auction that's undersubscribed, things could turn pretty bad pretty quickly. And what if they couldn't? What if the next $70 billion auction or whatever the number is every week, investors say, "Hey, I'm not going to lend to you at 4.4. I want 5," and the
Hmm.
10-year takes a big bump overnight. That would shock the system.
Where do you see China and India, and I mean, you can group it the BRICS uh, group. Where do you see them fitting into this global pie?
Well, that's a pretty broad question. I
I like
think
asking
that,
broad and specific questions.
yeah. So I think we can all agree that since China came into the WTO and became the world's workshop, that it's had on balance, a deflationary impact for the people like us. We've benefited from that. Now you could talk about the other side, the loss of jobs, the flight of capital, and all that. But just from a pure inflation perspective, that was driving down inflation in the U.S. for the last, call it, 30 years. As we nearshore and reshore and decouple, and as China becomes a more expensive place to manufacture, which has already been happening, that deflationary force ebbs a bit. And we could maybe say that long-term or midterm impact of AI as a way to drive productivity might be the next industrial revolution. And until that kicks in, I can see upward pressure on inflation being stickier because of we're no longer importing as much cheap goods as we used to.
Does that cause the feds to perhaps slow the tapering of interest rates just for the very fact that if inflation's stickier, then they might have to keep interest rates higher to avoid them going even higher on an inflationary front?
Here's another question. Will the country be able to afford these higher rates?
Hmm.
And will the Fed be forced to modify its expectations and raise its target from 2 to something else, say 3, even 3.25? Because how much longer can we keep refining our interest? We're not that smart. So we have these long-term liabilities, and what do we do as a country? We finance them through short-term instruments. I think the WALT or the weighted average maturities of the U.S. external debt. I read this is a year ago, but it was something like 18 months.
Hmm.
We should have been locking in those 30-year mortgages, right? But we didn't. So now we're very exposed to these interest rates, and everyone's read about just the interest carry on the debt going to roughly $1 trillion a year. How much longer can we sustain that before the Fed starts to feel some pressure, some political pressure?
What is preventing the feds from just acknowledging that that target rate can't go to 3%? Because it's largely just a number that they pulled out of the air. It's a country, Finland or some country in Europe decades ago just decided that that 2% sounded like a nice round number. And that's what caused the U.S. Feds to do the same. They just arbitrarily pick 2%. So why isn't there an appetite in your mind to move that up a bit to take some of this pressure off?
I don't know the answer. That's way above my pay grade. I can only think that the Fed really values its credibility because that's its coin of the realm. And if it feels like it goes back on its target, that it's going to damage its credibility and probably forever. So I think that would be as close an answer as a layman like myself can come to.
Yeah, that's fair. And I guess somewhat facetiously, I've lost all credibility in the feds. While they're trying to maintain that, and that I think that's a very valid reason.
Mhm.
I just look back to Jerome Powell saying that inflation was going to be transitory. And then they said, well, it might be a little bit longer than transitory. And then they said they had to retire the word transitory. And then it led to the fastest increase in interest rate hikes in decades, all while they were saying it's nothing to worry about here. We got this under control. So yeah, I say that somewhat flippantly, but it does seem like there's a few guys in a room getting together and they don't necessarily take the broad picture. The guy on the street, a guy in Detroit, Michigan, who's struggling to pay his bills, they're thinking about it from a much bigger level. And I agree, way above my pay grade as well, but
Yeah.
I still like just being curious about it.
Yeah, when you have these policy failures, as you describe, it's always the wage earner that gets hurt. Those of us that are dealing in assets, we, holders of assets greatly enriched during the low interest rate period, and the holders of assets will adjust to this new paradigm. But it's always the wage earner that gets caught in this transition in a very, very negative way. And again, that goes back to my personal view on the weakness of the consumer potentially manifesting itself over the next 18 months.
Yeah, there'll definitely be some data to watch, and I'm sure the feds are watching that pretty closely, or at least I hope that they would be. There's a question that came in from Gervine. Can we expect negative rent growth or stagnant rent with influx of new supply in 2 years?
Well, the supply cliff is coming. It's here now, but we have the slight overhang of supply in the present tense. We're still seeing positive rent growth in almost every market in the U.S. So long as national occupancies remain kind of in the low mid 90s, that's an environment that would suggest positive rent growth, although at a lower pace. So I don't see negative rent growth in the near future. If there were an economic downturn, an actual recession where customers are giving back second generation space, that's another source of supply that we really haven't talked much about. All of our thinking is about the marginal new product, but there's 17 billion square feet of existing. If companies start contracting, then all bets are off.
What do you think would happen in that scenario?
That's what happened in the GFC. Companies gave back space. You had second generation space competing with new space, and occupancies went from the mid 90s to the very high 80s. And at that point, it was a complete full on tenants market. As I said, I think in the last time we chatted, the leasing of industrial real estate and any commercial real estate, there's no price elasticity. And I think I used the Nike example. If I was Nike and I made too many basketball shoes, I can always sell them. I can keep discounting those until someone buys them. You can't do that in commercial real estate because it's very expensive for companies to make these moves. Commercial real estate or industrial real estate is like 5% of the total cost of goods sold. So I could take my cost to zero, and if FedEx isn't expanding, they don't care to talk to me. It just doesn't matter. My piece of the cost puzzle is immaterial. So when things lock up like that, like they did, it's 2 or 3 years to kind of have to wade through. And then back to where I was before. How do you hang on? You hang on by having low leverage and longer maturities.
I think the one thing that really resonated that you said 20 minutes ago or so is chase every tenant so that you have 1,000 batting average. Because I've seen so much in my career where there's landlords that will either drag their feet or they'll think that there's a better deal coming down the road, and that might happen. But having a tenant in hand, especially if they're a good quality tenant, and maybe you leave a little bit on the table, but you've got a great tenant, I think that that is so important in any market, but especially right now.
You're talking about the preservation of equity. You need to live to fight another day. And that means you need to have a full building if it's within your power to do so. Even if your returns are, way below your expectations, get the building full. As long as you said, like Chad, where you have a quality customer, and as long as there's a nexus between the quality of the customer, the amount of capital you have to spend to secure that tenant, and the length of the term. Those things need to all work in concert. No one wants to sign a 10-year lease at a big rent discount. No one wants to sign a heavily discounted rent where you've got to put a bunch of money into the building out of your pocket. So all those things have to mesh. It's not easy, but when you have the opportunity and they do mesh, you should try to bat 1,000.
Mhm. I think that's a great tip. How often are you having conversations in industrial about the differences between warehousing and logistics or distribution centers and call it class B or manufacturing space? Do you delineate those two often, or do you just mostly focus because you're in mostly logistics, that's where the lane that you stay in? Or do you look at both separately, or how do you frame that when you're talking with people?
Well, we're very picky. We manufacture about 80% of what we own. So 80% of what we own, we built. And by
Mhm.
by definition, it's new. It doesn't suffer from any obsolescence. About 20% of what we own, we acquire, and we avoid functional obsolescence. So we do not traffic in specialty buildings or buildings that have obsolescence, and just try to stay away from that. Sometimes that stuff gets really cheap and it's kind of tempting, but I think as an investor, chasing yield can be a fatal mistake. I'd rather take less return and go for quality because I know over the long term, and especially during periods of stress in the market like today, that I'll be better off. So I try to stick to the very highest quality assets that I can find.
What is some of that functional obsolescence that you would try to avoid? Ceiling heights, age of the
Yes,
building?
yeah, the things that you can't change. Well, you could change ceiling heights theoretically, but it's very, very expensive. But you don't have enough truck distance. Your truck court's too tight. You don't have enough auto parking. Um, Ceiling height's another one, and you don't have enough dock doors for the ratio of the rentable square footage. Things that are very difficult to change. Obviously, location you can't change, but in terms of functionality, it's usually ceiling height, truck court, docks, and auto parking.
How big is power becoming a topic of consideration with either properties that you build now or perhaps ones that you're looking to acquire?
Most of our customers are moderate users of power. Some of our customers are heavy users related to a very, very high automation for their interior MHE, material handling equipment. So we can't get power companies to say, well, we're going to guarantee you 10,000 amps of power, but we can get them to say, here's 3,000 amps, and then come back to us if you have a user that needs more. So it becomes a little bit of a chicken and an egg. How do I lease the space if I can't guarantee the power capacity? How can I guarantee the power capacity if I haven't leased the space? So there's some tension in the system right now, and that tension is greatly exacerbated with data centers. We're selling data center land in Phoenix, and frankly, um, the entire value of the property has more to do with access to power or the lack of than it does the actual ground and where it sits. But in our niche, in the logistics business, we're in pretty good shape. But it's becoming an area of much greater concern and focus from a risk management perspective.
I don't know if you'd heard this story. It actually came out in March, so a couple months ago. I just found it myself in it's fascinating. Amazon just bought a data center campus in Pennsylvania. So I believe there's just one data center on there right now, but they're going to add a few more. And there's a nuclear power plant right next to it, sixth largest nuclear power plant in the US. And so that feeds this data center campus. When the campus is fully up and running, it'll be drawing 1/3 of the power generated by that nuclear power plant, just a single data center campus. And that doesn't include all the ones in West Virginia, all the other ones under expansion. But this one data center campus, 1/3 of the power generated by the sixth largest nuclear plant. So I think this is a massive problem brewing, where especially in the US, where there's not an appetite to add more nuclear, they're trying to curb all the coal. And then in China's leading in nuclear power plant development and coal power plant development, and we're doing neither. So I'm so intrigued to see if there's people much smarter than me that must be working on this. But I'm just wondering if renewables and natural gas is going to be able to keep pace with this massively growing demand for mostly data centers.
Well, you said a lot of things. Yeah, while you just said that, China opened a new coal plant while you were talking. That's how fast they're doing that. And I think, for the right reasons, we're retiring a lot of that legacy, but we're gonna be caught short if something doesn't change. And natural gas is a natural transition if you believe in an all of the above strategy. But there's lots of political pressure on natural gas as well. So, we're a little bit engaged in a unilateral energy disarmament in this country right now. And I think that pendulum will swing a little bit as smart people and begin to figure out that we're putting ourselves at risk a little bit during the transition. We're not quite ready to go all alternative. Still need legacy.
Mm-hmm.
And on top of that, we want everything in our life to be powered by electricity now, from our stoves to our cars. Look at the demand curve and look at the supply curve. They're intersecting. And AI, the numbers that you see on these things are unbelievable. But I think I always have faith in generally Americans' creativity and the creativity of the marketplace to find solutions because it's profitable. So someone's going to find a solution, and maybe how to create these micro nuclear power plants that are on a flatbed truck, right? They're the size of shipping containers, and those can be deployed where they need to be deployed. I mean, something like that. We haven't talked about hydrogen. We haven't talked about fusion. I mean, there's all kinds of things out there that people much smarter than me are working on. But I know that the market incentive is there for someone or somebodies to provide solutions, and I just don't know what they are yet.
Yeah, it'll be fascinating to watch. I'm personally interested in it. So if I come across anything noteworthy, I'll send it to you, and please do likewise.
Yeah.
I know we've covered a ton in the last two interviews that we've done. Anything that I haven't asked you that you wanted to talk about?
Oh, wow. I think I was just looking at some notes here. Remember the art. Some of the listeners are probably remember the old saying, "Stay alive till 95."
Yeah,
Yeah. So now we're hearing "Stay alive till 25," and I, and I
I
think I think it applies actually.
I came up with a what's the other day? Pray to heaven until 27, but I'm perhaps being more pessimistic.
Yeah, yeah, that's right. And I was also remember the song Hang on, Sloopy, Sloopy,
Mhm.
hang on." Just got to hang on. And those that are a little over leveraged, got a little unlucky on occupancy or in asset classes where they have a high capital component to it. It's going to be very difficult. And again, I'm a buyer of office space. I have another office building under contract in New Jersey that we will shortly tear down and turn into a logistics campus.
Hmm.
So that when we talk about the great recalibration, that's part of the idea of moving the entire commercial real estate ecosystem towards higher and better uses. And those of us who grew up in large cities can remember that warehouses used to be very close to downtown. They were multi-story. They had freight elevators. What are all those buildings now if they still exist? They're artist
Lofts.
lofts, they're
Yep.
condos, they're right. So we go through this, and the market's very efficient, but it's during the periods of transition. Again, as I've said before, that people get hurt, but it also
Mhm.
means a lot of opportunity. So I'm very bullish on, you know, I'm very bullish on the mid and long term future of commercial real estate.
Yeah, likewise. So great hearing that from you in your position. So if nobody else has any questions, we could wrap up with that. But Doug, what's the best way for people to get in touch with you if they want to perhaps present a deal or just reach out to you?
Um, my information's on our website, so that happy to engage with anyone, any of your listeners, or anyone who wants to talk more about opportunities together. Um, we're leaning in, we're acquisitive, we're hungry for land opportunities in the select markets where we think it still makes sense. So we're not pencils down at all.
I'll put a link to their Dermody Properties as well, so people can reach out to you. And I've loved the conversations we've had for 2 hours now. So if you're up for it, sometime in the fall, I'd love to pick up the conversation again and just see what's changed in your mind, or if what we've talked about today has come to fruition, or if something's materially changed. I'd love to just keep this conversation going.
Well, so shall we make any predictions ahead of that?
Yeah, well, I think we probably should.
I think I'll predict by the end of the year that U.S. industrial vacancies will bottom at roughly 93.5% occupancy. I'm predicting there's no rate cut, or if there is, and I'm going to hedge, it's just a single one at 25 basis points. And I'm going to predict industrial cap rates are going to stay relatively flat between now and the end of the year. I think they've bottomed, but they're going to bounce along the bottom for a while.
And would you say that's in the 5.5 to 6 for
Yeah,
cap rates?
yeah.
Yeah, I'd say I'm largely with you. I think there'll be downward pressure on vacancy rates for sure, especially anything warehousing logistics. I think anything non-warehousing is going to be relatively steady. There's just hasn't been new supply added. That whole market's been relatively fixed for decades now. Incrementally new product added, but not a whole lot. And I think that with onshoring, reshoring, just general growth in the economy, population growth, it's causing demand for all this. So kind of that bifurcation, I think that there will be that downward pressure on warehousing, but I think everything else in industrial will be relatively flat. I would say some upward growth in rent rates and interest rates. I agree. I think in Canada we'll see a rate cut or two where our economy's quickly being run into the ground by our current leaders. So I think they're going to have no choice but to lower rates. In the US, I agree. I'd be surprised if it's anything more than 25 basis points too. Who do you think wins the election?
I am not even touching that at
Yeah,
all.
I think it's so random. Like it's just
Here's your prediction. Someone will win that nobody really likes. How's that?
that is a guarantee. Yeah, half the people will hate whoever wins.
That's where we are, I guess.
Yeah.
Yeah.
Okay,
But
well, we've got a couple benchmarks to see. We'll see. We'll pick this back up and see where how good we did at our predictions.
thanks, Chad. Thanks everyone for listening. Great to chat with you again.
Yeah, likewise, Doug. Really do appreciate it, and yeah, we'll be in touch.
Okay, take care. Bye
Okay.
now.